The 8 ways to make money investing in real estate. So in this video, I'm going to dive into what 8 different ways are that you can make money investing in real estate, even one rental property. And I'm also going to share an actual example of a rental house I own and what these numbers actually look like. And if you're new to the channel, my name is Tyler Roicki. I help people build income and wealth in real estate, and I run an international real estate team at eXp Realty. If you get any value whatsoever out of this video, all I'd ask is that you like, comment, and hit that subscribe button so that I can continue to share more tips and resources with you in the time ahead. And with that being said, let's dive into the video. So there's 8 ways that you could actually benefit from owning an investment property, not to mention if you utilize it in any fashion to do something that might help you personally, because we all need a place to live, and that might actually play into how you get started in investing in real estate if you haven't already. But I'll save that for another video. This specifically, let's look at a scenario where, say, you went out and got an investment property, specifically, let's call it a long-term rental. So you're gonna own the property, you're gonna rent it out and lease it out to a long-term tenant who's gonna pay monthly rent. So how can you benefit from that scenario? Because a lot of people think about, if they're making money on the rent, and we'll talk about that, but that's actually only one of the 8 different ways that you could potentially benefit from it. So let's get right to it. So the first benefit is equity capture. Now, this would be if you were to purchase the property below market value. And it's not necessary that you do that in order to get an investment property, to be clear, but there are scenarios out there where people are buying properties below the full market value, and when they take ownership, there's effectively equity that they capture in the process, which is the difference between the market value and what their purchase price is. And there could be a variety of reasons for that. Sometimes properties appraise higher at purchase than the actual contract price. Other times, you're getting a deal going into it because the property needs some repairs and thus is being sold at a discount. Sometimes it's off market and there's a discount built into it. But regardless of the reason, that's the first way you can make money investing in real estate, is equity capture. The second way is cash flow, and this is probably the most commonly known, or at least one of the most talked about things, especially in terms of investment property. But your cash flow is the difference between the total monthly expenses to own the property and the rent. So ideally, the rent's higher than whatever the total monthly expenses are, because if it's not, then you're going to be cash flowing negatively and it's going to cost you out of pocket each month to own the property. So you probably want to be in a scenario where the property is making you money as far as the cash flow every single month. And so some of the monthly expenses to account for are going to be the PITI, that's principal, interest, taxes, and insurance, talking property taxes. But these are all expenses related to the actual property. So the payment itself, part of it's going towards principal, part of it's going to interest, and then taxes, that's your property tax bill, and then property insurance to own the property. Now, on top of that, if you have a property manager, there's going to be an expense for that. So you want to factor that in, especially if that's the case. It's probably good to account for that in your numbers regardless. And then also repairs, capital expenditures, and vacancy. So repairs, that's like your month-to-month things that need to be taken care of in the house. Capital expenditures is more of the long run needs, like if you needed to replace a roof, or just any of the long-term expected items that will need to be taken care of, because that should be budgeted in some sense, because they're going to need to be taken care of at some point. Third thing's the vacancy. That's the lost rent from any amount of time that the property does not have a tenant in place, which if you're dealing with the turnover of tenants, that's natural that would happen to some extent, but you definitely want to minimize the amount of time that is so that you can maximize your cash flow. But that's what to take into account. But at the end of the day, your positive cash flow, that's the second way to make money on an investment property. The third way is the principal pay down. So this is something that I think gets thought of less often. But fact is, if you're paying a mortgage, there's a portion of that payment, at least if it's not an interest only payment, that is, but most like 30-year amortized mortgages are gonna have a portion of the payment going towards principal pay down. So that's your monthly, it's part of your monthly housing expense, but it's the portion that's going directly towards your equity. And the way that a mortgage is amortized, there's a tendency that it be more over the course of time. So the amount that's going towards your equity will actually increase the longer you own the property and the longer you pay in towards that mortgage. And so that's your principal pay down, but bottom line is that's money going directly towards your equity, and it is a part of your upside in owning the property, especially if you have a tenant in place that's paying that for you. The fourth way you can potentially make money on an investment property is market appreciation. So simply put, whenever the market goes up, the housing market, your local market, what have you, the values of the houses in your local market will have a tendency to go up. And along with that, rents can go up too. I think this is another thing that doesn't always get thought about, but the fact is, if your mortgage payment is fixed, your rents can actually increase, and you can actually potentially cash flow more money over the course of time as that happens as you raise rents. So principal, interest stay the same. Sometimes, taxes, insurance, that can change, especially property taxes. Eventually they'll probably go up, but the principal interest portion of the payment will be fixed across the life of the loan, even if rents go up significantly. But even that aside, market appreciation is the value of the house going up. So if you paid $300,000 for a house and it goes up 5% per year, that's money that you're going to gain, equity that you're going to gain in the process just by owning the property. And you tend to not really realize it until you either sell or cash out, refinance, or do a home equity line of credit and utilize that appreciation to perhaps do more. But I'm not going to get more into that now. But bottom line is, if there comes a time you sell that property, that is money that's going to be factored into what the return is on the property. Now, the fifth way that you can make money investing in real estate is through depreciation. Now, we're getting into the tax side of things here, but this is a tax benefit, and it allows someone who owns a rental property to deduct the cost of the rental property over a set period of time. So what that means, if you're looking at a single family rental, at least at this point in time, it can get deducted over the course of 27 and a half years, which, that translates into about 3.6% of the value every single year. So basically you can take what that value is and deduct it against your tax bill. So the fact is, it is a tax benefit for the use of a property that can in turn help you lower your tax bill and potentially even drop you into a lower tax bracket depending on what your numbers all balance out at the end of the year. But that's something that is best put in the hands of a CPA, whoever handles your taxes for you, especially if they're knowledgeable about real estate. They can help you make sure that's taken care of and done the correct way. And that brings us to our sixth item of how you make money on real estate, which is another tax benefit, which these are your tax deductions. So we already spoke about depreciation. I'd put that in a category of its own, since it's something unique to owning a rental property that you get to do with the actual value of it. But your other deductions have to do with the cost of actually owning the property that you're going to be incurring on an ongoing basis. So some of these items include mortgage interest, property taxes, property insurance, repairs and maintenance, and even property management costs. So those are all items that can potentially be deducted against your taxable income and help you save money on your tax bill. Again, best thing I can tell you with that is seek out advice and guidance from your CPA of how to best account for that and to make the most of your opportunity to save on taxes by owning property. But make sure you have all your expenses accounted for, and it should help simplify that process. And that brings us to the seventh way you can make money investing in real estate, which is leverage. And I wanted to throw this in there because it's an important concept to understand about the benefit of actually owning real estate. Because when you have the ability to control an asset for the fraction of the actual value of it, it means that you get to benefit in all of the upside of owning that asset with a fraction of the cash required to actually pay for it in full. So like for instance, say you had $200,000 and say that you could buy one rental property cash for that amount, or you could use the same amount of money and put 20% down on 5 rental properties. So consider this, would you rather have all the upside on a $200,000 property, especially if we're looking back at these 5-6 categories we've covered thus far? Or would you prefer to have the upside on $1 million worth of property that you can control using the same amount of money? And not even just control, but like own using the same amount of money. And so that's something to consider, because there is a thought out there that, hey, it's good to not owe money. Well, I think there's good debt and bad debt, but like you just got to consider, if you factor in all the upsides and benefits, what could it mean if you properly position yourself and utilize this particular lane of real estate? Because if you're not leveraging, if you're not putting a portion of the money down, if you're just paying cash, you don't necessarily have this benefit, and you don't really get to utilize your cash to actually control more asset value and have more of the upside that comes along with that. And of course, there are some more expenses built in when you're funding and financing the properties, but you also just have all this other upside working for you. And at the end of the day, you have more properties being paid down, putting the same money to work, which the long-term benefit, that's where that can really come into play. And that brings us to the 8th benefit of owning real estate, which is velocity of money. And again, this is another thing I wanted to throw in there, concept that's important to understand, and that's what you can do with the cash flow and potentially gained equity over the course of time to actually build more income and wealth in the process. So like for instance, if you're taking the freed up cash flow that you're earning and even some of the equity you're gaining over the time and putting it back to work in new properties or new investments, you can actually create a snowball effect the more you do this, allowing you to purchase more and more properties sooner and enjoy all the benefits as time goes on. So it's easier if you kind of can like visualize what this looks like and imagine it, but like, just if you can play it out over the course of time as you get more doors and properties, you have more cash flow coming in sooner, you have more equity being gained sooner, and that's something that you can use sooner to get more properties. And what's it look like when you keep extrapolating that out over the course of time? And that's what I mean by velocity of money, because on the other extreme, you could let all that gain sit there. You could, take the cash flow, put it in a bank account. You could take the gained equity and do nothing with it, just let it sit in the property. But that's money that's not moving as quickly to go out and create more upside. And so that's what I mean with velocity of money, is depending on how often you actually put it to use and doing that sooner rather than not, that can actually help you get more of all these benefits sooner in the process and ultimately to create more wealth sooner. And those are the 8 benefits, but I want to round it out by sharing an actual example with a rental house that I own and the real numbers behind it and how it plays into all of these categories. So this property, a single family home, I purchased 2 years ago for $305,000. I paid full market value at the time for this property. It was actually a multiple offer situation. I paid over asking price and got the property. So 0 equity built in. I put 20% down on this property, so $61,000. So I financed $244,000 at 2.99% interest. That's where rates were at the time. And I've got that rate locked in for all of the time ahead that, this is payable. The PITI payment is $1,733. There's a $50 a month HOA fee as well. And there's a plumbing service that I have a monthly payment to of $13, which takes care of an annual water heater. There's a tankless water heater that needs an annual service, and that's essentially what that's for. But that brings my total expense to $1,796 monthly to own this property. So cash flow, I rented this property at $2,550 a month, which is market rent. I do have a property manager I hired to manage it. That way I don't have to deal with tenants, toilets, and all those other kind of calls you're gonna get in the process. I wanted to be hands off. I wanted to have someone else take care of that for me. So for me, that's worth the fee, and to have it more as an investment working for me than me having to go back in the trenches and take care of it. But even with the property management fee, I am cash flowing $550 per month after the property manager is taken care of. So that amounts to $6,600 per year. Principal pay down, if I look at the principal and interest payment, at this point in time, it's $446 a month in principal pay down, and that's going to increase over the time that the loan's amortized. So if you take cash flow principal pay down, that's about $1,000 a month in benefits right there. But we are not done, because next we're going to look at the market appreciation, the fourth category I mentioned. Well, the growth has been unusually high for the past 2 years, but looking at comparable sales today, I would put the home's value at $410,000. So I've had about $105,000 in equity gain over just over 2 years. And I would tell you, just that is not normal. I would not expect that. I would not make an investment based on that being a thought that could happen wherever you're at, unless you're just buying something significantly under market value, which, like I mentioned, that wasn't the scenario when I purchased this house. I paid full market value. That's just what the market's gained in that course of time. Now let's talk about depreciation. Depreciation, if I look at my cost basis and divide that over 27.5 years, as the IRS guidelines would state, that amounts to about $11,090 per year that I can deduct from my taxes based off of what I paid for the property. And so I ran some numbers on this, but let's say that the marginal tax rate was 22%. It looks like that would be roughly $200 in tax savings a month, or about $2,400 a year at a 22% marginal tax rate. So that's just going to vary person to person on that. But for me, tax deductions too on this property, if I look at the taxes, property taxes, that amounted to $6,254. Property insurance amounted to $1,979. Mortgage interest amounted to $6,972. And property management fees came into $2,448. So if I total up all those expenses, that's $17,653. And of course, if there are any maintenance needs or anything of that nature, I don't really expect any capital expenditures in the near future, but there could be some maintenance needs, and it's hard to say what those would come in at. It just depends on what it is. It could be $1,000, $2,000, but I'll just throw that out there. But let's just take those 4 expenses that I for sure know are going to be a part of the process. That's going to amount to about $17,653, which at a 22% marginal tax rate, that equates to about $3,800, $3,900 in tax savings, or about $325 a month. So bottom line, what do all these benefits amount to? Well, if we take the total cash flow, principal pay down, depreciation, tax savings, etc., that amounts to about $18,275 a year, or about $1,500 a month in upside to own this property, plus appreciation, which I already covered. And I'm not even going to break down the appreciation to monthly, because it would just be absurd, and I wouldn't expect it to continue at that exact rate moving forward. But it is significant, and I do have the potential to tap into that equity to do more now or in the future. And so how could I do that? I could either sell the property, I could refinance, or I could take out a HELOC, a home equity line of credit, and I could use the funds from that to potentially purchase another investment property, or in the event that I sold it, I might be able to actually purchase 3 properties by selling that one. So there might come a time where it will make sense to do that. But that's an example, using a real example, real numbers of what this looks like, and hopefully informative to help you understand the benefits. It's not just cash flow. It's not just about buying a property at a discounted value. I mean, I think this is a prime example of that, which is I paid full market value for this, but nonetheless, these are the benefits that are in place to actually own this property. And so that's how you can make money investing in real estate. The most important thing is that you commit to getting started with it and actually do it, because after you get the first property, the next one should come a lot easier, as long as you actually commit, put your head down, get through any challenges or obstacle you got to overcome in the way, and keep building upon the long-term vision of why you got started in this journey in the first place. and to continue to build upon it and add to it over the course of time. And so hope that was helpful. And if you got value out of this video, if you found it insightful, do this. Hit that subscribe button so that I can continue to share more videos, resources, information with you to help you grow and develop on this journey ahead that you're on in real estate. And if there's anything I can potentially do to help you now or in the future, I do run an international real estate team at eXp Realty. I have agents that cover most of the United States, especially the larger market areas, but even some small towns in between too. But if you need help with real estate anywhere, whether you're in the business or need help navigating the investment real estate world, perhaps getting your first or next property under the belt, I've got an extensive network of people who I could potentially connect you with. So reach out, email me if you need a connection or if you need help with anything on this journey in real estate that you're on. And with all that being said, thank you so much for watching the video. And until next time, I'll look forward to seeing you on the next video.